Okie dokie. Okie dokie, everyone. Hello there and welcome. This is James Alexander of Wise Bank. And thank you for joining tonight's webinar. I hope you're all having a fantastic day and you're ready to be educated. Now, today's webinar is called How I Discovered Technical Analysis, or simply Discover Technical Analysis. It's obviously written by yours truly. Like I said, my name is James Alexander. I am the market analyst here at Wise Bank. Now, let me do a brief introduction on myself. This shadowy, bearded, almost smooth-looking person is myself, believe it or not. In fact, actually, as they say, pictures make you look better, and this is certainly the case. But let me tell you a little bit about myself. I've been, like I said, I'm the market analyst at Wise Bank. I've been in the financial service industry for over 20 years. I actually was an IFA back in the UK, where I did mortgages, pensions, and alternative investments before moving into this arena of online trading and CFD trading. I'm indeed a published writer. I've written several articles and opinion pieces, which have been published in the lights of the Financial Times Advisor, Market Watch, The Street, what else was there? I'm trying to remember now, City AM newspaper, and several Forex trading magazines. As well as that, I will say this, I'm an extremely passionate individual, and I am an avid market commentator. I like to commentate a lot on what I see is happening in the market. And well as that, because people say I like the sound of my own voice, even though I am actually from the West Country. As you can tell, I'm a Brit, so don't hold that against me. I'm a well-known public speaker, and I've spoke in several events around the world, including the likes of Dubai, Singapore, London, Barcelona, etc. I won't bore you with the rest. But anyway, on with tonight's webinar and agenda. Like I say, this webinar is called Discover Technical Analysis. It's all part of the series I'm doing called the Discover series. And tonight we're talking about technical analysis. So the agenda will cover the following. First of all, in a nutshell, what is technical analysis? We'll then discuss the battle between fundamental analysis and technical analysis. Because the argument is some people believe in fundamentals and trade just on fundamentals. Others tend to trade on technical analysis. I'm going to compare the two very briefly, and we'll discuss the pros and cons with both. Then we're going to go through the actual theory behind technical analysis. Why does technical analysis with your trading work, or if it works? What's the theory behind it? Then we'll discuss, and I will do an introduction to moving averages and Bollinger Bands, because this is more of an introduction, so we're only going to discuss a few technical analysis indicators. Then we'll discuss the RSI, Relative Strength Index, and then we'll discuss the other webinars coming up in the next couple of weeks for Wise Bank. And as always, I'll do my question and answer session at the end, and you can ask me any questions you like, and if I know the answer, I will certainly give it to you. So, what is technical analysis? Technical analysis is a method of trying to establish potential future direction of an asset by studying previous or past price data and volume. So in a nutshell, it's trying to establish where a currency or a commodity or a stock may go in the future based on calculations of where it's been in the past. That's basically what it is. Now, like I say, there's often that battle between the people who believe in fundamentals and those who believe in technicals. Okay, so what is the actual difference between the two? Let's compare the two. Now, fundamental analysis or fundamental analysis traders, what these individuals do is basically they try and analyze and identify the intrinsic value of an asset. What that means, Mr. Alexander? Well, simple. They try and identify what something is actually worth. Now, they base this on studying the overall picture of an asset by taking into account economic conditions, industrial conditions, and financial conditions. So they believe by working out all the nooks and crannies, going deep and analyzing this and that, they will find the true value of an asset. So they look for the true value of something. That's what fundamental analysis goes on. Technical analysis, on the other hand, they believe that the fundamentals have already factored in. They've already been taken into account into the value of the asset. So they ignore the intrinsic value of an asset. They ignore it. They believe it's already been priced in. It's already been taken into account. So what they do instead is they try to look for patterns and trends to try and predict future price movements. So they forget the overall value, but they look for patterns instead and trends and look for it that way. That's what they do. So one is based on intrinsic value, or trying to guess what the intrinsic value. The other is ignore all that. Let's look at previous behavior and try and see if we can identify a pattern for where we can potentially buy or sell in. So the theory behind technical analysis really is this. The theory is that previous trading activity can give a better indication of what direction an asset may go to. So they look at the heart, they look at the past. The basic concept was really originally developed from what's known as the Dow Theory, which was from the writings, surprisingly, very creative name of this, by an individual by the name of Charles Dow. The Dow Theory believes that price movement is not random, but follows patterns and repeating trends. Now, when those who are technical analysis traders, give me a second, those who believe in technical analysis or try and use technical analysis to judge where the asset may go, they use things called technical indicators. Okay, technical indicators. And technical indicators are basically calculations that take into account price, volume, and demand over a period of time. Now, example of such technical analysis indicators include the likes of the relative strength index, which we'll have a little chat about in a while, stochastics, MACD, Bollinger Bands, something else we'll talk about in a few more details, trend lines, simple moving averages, and the commodity channel index. This is just to name just a few, okay, because there are hundreds out there. For tonight's webinar, we're only going to talk about 3. Starting off with simple moving averages. Simple moving averages, or simply SMA. SMA is calculated by adding up the recent closing price of an asset and then dividing it by a certain time period. So for example, you take a closing price of, say, the euro dollar, okay, over the last 10 days, and you then divide it by that time period. And that is how it's calculated. That's how the calculation is done. Now, the SMA, or the simple moving average, is used by technical analysis traders, okay, to try and identify a trend and used to spot potential support and resistance levels. So that sounds really good, Mr. Alexander, but explain a little bit more. What does that actually mean? Well, let me put it this way. Now I'll get my little infrared pen as well so I can highlight it a bit better. Here we go. The theory is that if an asset is trading below the simple moving average, it's on a downtrend. Okay, it's on a downtrend. It means it's going down. If an asset breaks above the simple moving average, it's on an uptrend. So that's how they try and use it to say where the direction an asset's going. At the same time, the theory goes that if it's below the simple moving average, i.e. the downtrend, then the simple moving average will act as a resistance, i.e. the ceiling that the asset would rise to, touch, and start to sell off from. If it's above the simple moving average, so i.e. in an uptrend, the SMA changes its role and then becomes like a resistance. The asset will come down, touch it, and then bounce back up again. So here's my example here. This is the euro dollar. Let's have a look. So here, clearly, all right, under the SMA is the blue line. Okay, it's an SMA of 20. That means over 20 days. Okay, so it's under the blue line, which means the euro dollar currently at this time was on a downtrend. So, okay, fair enough. It's under that. So, yeah, it's moving downwards. But does it act as a resistance? Let's see. Ba-bom. Yes, it does. It's on a downtrend, comes up, touches it, and carries on moving forward, moving downwards. And again, comes back up, touches the SMA, hits it, and again, finally moves downwards. Finally, around here, it breaks it, which means the euro dollar then is on an uptrend, but comes down, touches it, bounces off it, so it acts as a support. Then it breaks it, comes under, so on a downtrend, tries to break it again, acts as a resistance, pushing it down, and then at the same time, breaks here, moves up, doesn't at this time act as a support. So like I always like to be absolutely open. With all indicators, they work sometimes, but not always, as you can clearly see on this example. Breaks under, but again, downtrend, acts as a resistance, pushes it downwards, and so on. As you can see, breaks it, acts as a resistance, then breaks above it, then acts as a support. So that's how people who are technical analysis uses the SMA. But that's not just the only reason why people use the SMA. There is another way of using the SMA, and there's another theory and another technique called the simple moving average crossover. Now, as we say, the SMA is used to calculate the recent closing price and divide it by a certain time period to identify the trend and potential support and resistance. But the crossover is different. A crossover is where you take two simple moving averages. Okay, now on my chart here, as you can see, I have a simple moving average here, and that's 10. Okay, and that's the purple line. And then I have a simple moving average, which is 20, which is the blue line. The theory is that if a smaller moving average, i.e. the 10 in our case, crosses below or above the larger moving average, which is the 20, indicates the trend has changed and the trend is going to start to move upwards. So if the smaller one breaks above the larger one, the trend has changed and the asset's going to start to move upwards. If the smaller moving average, i.e. the 10, crosses below the larger moving average, i.e. the 20, then the asset is going to start to move downwards as being sold off. Hang on, what happened there? Sorry about this. Snooze. Yeah, it happens. So, reiterate what I was going to say. So if the smaller moving average goes below it, it's on a downtrend. Okay, so 20 is the large, 10 is the small. Remember, 10 above moves above the 20 uptrend, 10 below goes below the 20 means downtrend. So let's see if this actually works. Again, this is the euro dollar against the chart I took yesterday. Okay, it's on a 30-minute, as you can see. All right, so remember, the 10 is the purple, the 20 is the blue. Let's have a look. Crosses below, downtrend. Crosses above, uptrend. Crosses below, downtrend. Crosses above, uptrend. Crosses below, downtrend. Crosses above, uptrend. Crosses below, downtrend. Now, if it was this simple, of course, we'd all be multimillionaires. But let's face it, it's not. This case on this chart, the theory works. But here's the thing. The moving average crossover is a lagging indicator. So it doesn't take into account market fundamentals or things which can suddenly happen in the market. So this clearly shows that it's working on this occasion. It doesn't always work. So don't take this as the gospel that this is always going to work, because it's not. But I'll show you another example. This is on another end. This is the dollar Japanese yen. Okay. Remember, 10 is the small, blue is the 20, so 10 is the small, and 20 is the larger. Crosses above, uptrend. Crosses below, downtrend. Crosses above, uptrend. This is a daily chart, by the way, ladies and gentlemen. Okay, so it's a longer period chart, daily. Last was 30, so it goes to show that you can use these indicators on different time frames. Uptrend. Still remaining an uptrend, bouncing it. They were using a support here, bouncing up. Carries on, being above the larger, so 10 above the 20. Uptrend. Breaks below, then we have downtrend, then breaks above, uptrend, and here we go. This is where I want to show where it doesn't always work, okay? Because look, it's above, but the asset channeled under, but it's still slightly remaining on the uptrend. So again, like I say, it's not a secret formula. Bollinger Bands. This is another very popular technical indicator. Okay, and Bollinger Bands was developed, again, they're so imaginative and creative with the names of indicators. Bollinger Bands was developed by a guy, surprise, surprise, called John, wait for it, Bollinger, in the 1980s. Now, traders try to use Bollinger Bands to measure market volatility, and the theory is that when the bands are wide apart, there's a lot of volatility in the market. And when they're closer together, the market is quieter. Bollinger Bands consist of a moving average as well in the middle, which I'll show you. And traders also use Bollinger Bands, again, to try and identify potential support and resistance levels. So here is our Bollinger Bands. This is the bottom band. This is the top band. And in the middle is the moving average. So the theory is the bottom band will act as a support, i.e. a level an asset will come to, and the market will start buying in, pushing up. The top band will act as a resistance, i.e. an asset will rise to, and the market will start to sell off again. And the moving average is like the middle of it. And at the same time, if the bands are wide apart, a lot of volatility. If the bands are narrow, not so volatile. So let's see if this works. Again, this is a daily chart, okay? Excuse me, frog in my throat. So the asset comes down, hits the bottom band, and surprise, surprise, the market starts to buy in again, moving in upwards. Carries on moving upwards and moving upwards, not quite touching it, hits the top band, and then starts to sell off again. But only to the middle section. And I'll talk about this theory in a minute. Hits the top band again, comes down the middle section, breaks the middle section, the moving average, comes down to the bottom band, market starts to buy in again, and then up, hits the top band, market starts to sell again, then hits the bottom band, market starts to buy up again, pushing the asset up further, and hey presto, hits the top band, market starts to sell off again, hits the bottom band, market starts to buy in again, hits the top band, and this is something which I want to talk about. Now, here, and here, for example, okay, and indeed around here, okay, it doesn't break the middle band. Now, what some traders do, the more risk-averse traders do, is what they do is they look for the top bands and they either sell from it or the bottom bands and buy for it. But they look at usually they take profit around the middle band to lock in a little bit of profit, or use trailing stops to move a bit of profit in. Because as you can see, it hit the top band, didn't really break the bottom band or hit the bottom band. It carried on moving up further. So people then maybe set, take profit and lock in profit around these sort of areas, or trading stop in case it doesn't break it to go to the bottom band. At the same time, range traders look for Bollinger Bands or market patterns like this. They don't trade when the bands are wide apart like this. Instead, they trade when the bands are narrow apart. Okay, because it means the market's not so volatile. When the market's not so volatile, what that basically then means is the market is a ranging market. Ranging market, as we all know, trades between two levels. So this is like a ranging market. So this is what people use Bollinger Bands for as well. Let's do another example here. This is when it bands are volatile and on ranging. That's volatile. The bands are wide apart. Okay, and people who range trade don't trade when the bands are wide apart. They trade like this when it's narrow, because then they can see it trading between two levels. And it's, it's like, that's how they see it. But when it gets wide again, they step out and they wait for it basically to get narrower again. Now, the final indicator we're going to talk about tonight is the relative strength index. Again, a very popular, very famous indicator. What the RSI does, well, I call it infamous, in fact. The infamous relative strength index is a momentum indicator. Okay, so it basically tries to predict future movements. Okay, it's an early warning indicator. And it's used to measure if an asset is potentially overbought or oversold. Now, the RSI trades between a value range of 0 and 100. The theory is that if the value is above 70, remember 0 to 100, 70, the asset is potentially overbought. And that could cause the market to start to sell it off. And if the value then drops below 30, the asset is then potentially oversold, which could then encourage the market to start to buy in again. Sounds too good to be true. I'm afraid sometimes it is, but let's look at an example. So here is RSI. So we're close to 70 and the 30 level. Okay, so remember, if it's coming up to 70, potentially overbought, sorry. If it's close to 30 level, potentially oversold, and people might start to buy it again. So let's see what happens. What is this? This is the euro dollar again on a daily. So approaching up just about to 70, so high. Here we go. Market starts to sell off again, starts to sell. So, yep, that time it was correct. This time ignored. Here, again, coming up to the 70 level, it's a future prediction of price movements. Guess what? The market starts to sell off. So that time it is also again correct. Comes down to way below 30, 29 level. This means indicating potentially oversold. Guess what happens? The market starts to buy in again. That correctly works. Then it comes up close to the 70 level, around this level here. Market again starts to sell off, and so on. But what I will say, if I go back to this, okay, it's not always crystal clear, because look, here is giving us the same reading again. Potentially it should be overbought, but guess what? The market doesn't react. Okay, so like I say, it's not like all indicators 100% accurate, but it's something you can also use to help. Now, up and coming educational events, which I'll be running for Wise Bank. Now, the next two coming up is on the 20th of September. I'm going into a little bit of psychology of trading, and I'm going to discover the mind of a trader. What makes a difference? And it's questions you need to ask yourself in this webinar. What makes a difference between a gambler and a trader? And then on the 27th of September, I've talked about it already during this webinar, support and resistance. On the 27th, I'm going to discuss a lot more about that, how to discover support and resistance, so how to recognize support and resistance levels, how to calculate them, and some trading techniques you can use to trade off support and resistance. On that note, that's enough for today for introduction or technical analysis. So I open up the forum to you, fine people. Please ask me any question, and if I know the answer, I'll be happy to give you the answer. Like I say, if I know it. So please, any questions at all? Excuse me. God, I've got bad cold, bad chest today. It's the aircon. Any questions whatsoever from anybody? Honestly, don't be shy. I won't bite. Okay. Did anybody at least find it interesting or useful? Did you learn something today? Okay. Question out to you then, people. You fine people. In the future, because don't forget, I do this education series for you guys to help. Is there any area or any subject you would like me to cover? Indicators seem to lag events. Well, they're absolutely, of course. There's lagging indicators. Because indicators lag events because, of course, they're taking financial or previous historical data. So this is why they lag, especially moving averages and RSIs, etc., are lagging indicators because they're based on previous price action. They're not, again, they're not looking at future events. So this is the theory. You know, like I say, technical traders believe that patterns are developed by looking at the past. Fundamental traders believe in looking for the overall value of an asset. Okay. Now, in my personal opinion, okay, it's just a personal opinion, no way whatsoever to be taken as advice. In, you know, my experience, it's best to have combined the two. By all means, use a little bit of technicals to understand potential support and resistance, but at the same time, understand to, there you go, there we go. 1 second, it's a good question. So we missed the boat. No, not necessarily, okay? Because like they say, they don't take into account massive market movements or breakouts, okay? But indicators are very good when the market is potentially ranging or are not so volatile. So it doesn't mean you missed the boat. It gives you the idea where you could potentially enter or exit from, or where the trend is. Okay, so it's not necessarily lagging. It's giving you an idea when they are lagging, but it also gives you an idea of the levels. So if you compare the fundamentals and understand the sentiment and the actual overall story of what's going in the market, because there's more than just technical analysis to learn to be a good trader. There's so much more. It also gives you an idea of where to go. Ian, good questions, by the way. It will be good to understand the calculation behind some of the other technical indicators, RSI and Bollinger Bands. Great question, Elizabeth. Again, like I say, look, luckily, because I'm not a mathematical genius, which I'm not. Oh, thank you, Ian. That's a really good question, though. I like that. Good question, Ian. But Elizabeth, yeah, you know, it's good to understand the calculations between other technical indicators and RSI and Bollinger Bands. Bollinger Bands are simply based on, or are taken with moving averages. Okay, that's why you have a moving average in the middle of them. Now, in my opinion, if you want to understand how to calculate things, it's good not to necessarily understand the calculations of indicators, but understand how to calculate maybe other ways of calculating support and resistance. Okay, because the indicators are there for us. The systems are based on this calculation, that parameter, that parameter. So it's done for you. What would be a good idea is understand how to calculate pivot points. Like that. Chris, that's also a very good question. I'll come to you in a second. So it's actually personally, instead of understanding the fine calculations of, say, Fibonacci retracement, for example, which is very complicated, I believe in like keeping it simple and understanding how to calculate pivot points, support and resistance, like how to calculate. I mean, I'll tell you, I'll do a study on this on my support and resistance. Like if you want to calculate support and resistance, you take a closing price of an asset, a high and the low of an asset during a period of time, say like a day. Okay, you then divide it by 3, which gives you the average, which is then the pivot point. To calculate the resistance, then you get the pivot point, times it by 2. Okay, take away the low, that gives you the potential resistance level. Same time, you get the pivot point, times it by 2, take away the high, and that gives you the potential support. Those are the sort of calculations worth knowing manually. Or in your head, then understanding the final workings of Bollingers and RSIs, in my opinion. But good question, Elizabeth. Very good question. Chris, do indicators outlined today work over short periods of time, like hours? Now, actually, one of the indicators I showed, actually, if you notice on one of my charts, let's go back. Oh, man, sorry. Let me see a better way of doing this. Give me a second. Was it this one? Yeah, there we go. This was a 30-minute chart. Okay, where it actually showed the direction again, being acting as a resistance till that point till it broke, support till it broke. So again, this moved over 30 minutes. So you can, however, what I would say in my personal opinion, okay, and this is my opinion only, not to be taken as advice, I've never been a short-term trader, so I've never traded on 5 minutes. The most on a range trader or swing trader uses 30, but I always personally prefer 1 hour, 4 hour, or really if I'm I'm more of a position trader, I look for longer terms like daily or weekly. But yeah, they can work, but shorter time frames are more prone to be victim to more violence of the market, like sudden breakouts or sudden big sales. So I would always, like I say, use these indicators over a longer time frame. And you can use it for like an hourly, like I showed you. I used it on the 30 there as an example. An hourly or 4 hourly, I think personally works it better. But a good question, Chris. Any other questions at all? Okay, Ian, Elizabeth, and Chris, great questions. Is there any subjects in the future that you would like me to possibly cover in the future? Any maybe do a case study on a currency pair or a commodity, or do a case study on market sentiment, maybe like the COT report, for example, the Commitment of Traders report. Is there any area you would like me to particularly go over? Anything in particular? Ian, Elizabeth? Fibonacci retracements, good one. I like good one, Chris. Okay, we'll definitely do that one. In fact, actually, I haven't got that part of my schedule. Let me go back, sorry. No, I've only got 2. Discover support and resistance. I could add that. I could do a piece on Fibonacci on that one. Actually, on discover support and resistance. I'm going to do breakouts and correlations on this one as well with support and resistance. But I could add it into that. But I would, if you're really interested, Chris, and it's a great request, I will do a special webinar just on that, if you'd like. That's not a problem. Anybody else at all? Elizabeth, would you like me to do a particular subject on anything? Excuse me. Okay, another good one. All right. Another good one, Ian. Okay. Maybe look at the currency pair and dissect the movement. Okay, I like that. What currency pair? Which one in particular would you like me to do? Let me ask you a question. Ian, are you a euro-dollar pair? Euro-dollar player? Are you into euro-dollar? Okay, Elizabeth, not on the particular moment. Okay, Elizabeth, anytime though, if you have any ideas or anything you like, please just let me know. I'm all happy do a case study or do a particular subject matter. But thank you for replying, Elizabeth. Thank you. Ian, to your request, maybe look. You're a pound dollar. Ian, are you from the UK by any chance? Like me? So we want to do. Are you a cable trader then? Yes. Okay. Cool. Cool. Actually, to be fair, it's a really good. That's a good one because I do a lot on the cable and the euro sterling. Certainly, obviously, for my sins. Join the club, mate. Yeah, for my sins too, buddy. I'm a Brit as well. Yes, as you know. Brilliant. Absolutely brilliant. Okay, yeah, definitely. Definitely. Okay, it's a new private trade. Okay, cool. Okay, look, I love that idea. Actually, what we'll do, because I talk about the pound dollar a lot. Obviously, at the moment, you have to be living under a rock not to know about the brick exit. Obviously, the brick exit is a driving factor behind a lot of the cables movements at the moment. So yeah, that'd be brilliant. Actually, I've enjoyed doing that one. So yes, definitely, I will definitely do a case study and we'll go over, perhaps we'll do look at some live charts at the same time actually, and look at it live as well, which would be really good, I think. So yeah, we'll definitely do, we'll do a study over on the British pound, US dollar. Absolutely, definitely. I love that, Ian. We're in, absolutely. Is there anything else? Any other questions? Anything else anybody else like me to ask? Okay. Did you guys at least enjoy tonight a little bit? I didn't get too boring for you. Or you're not sick of my voice already? I can take it. No, we're all good. All right then, ladies and gents. Listen, thank you so much, every single one of you, for joining me tonight. Now, thank you, Chris. I appreciate that. Thank you. No, I sleep. Yeah, Ian. You listen to me long enough, my friend, you'll be asleep. Don't worry. I have a very soothing voice. Thank you, Elizabeth. Thank you for your kind words. I'm glad you find it informative. In that case, guys, listen, it's been absolutely brilliant. Thank you so much for joining me tonight. Special shout out, Ian, you've been amazing. Thank you for your great questions. Elizabeth, again, thank you for that brilliant question on indicators RSI. And I'm glad you found it informative. Chris, brilliant stuff on the indicators, and definitely we'll do one on Fibonacci retracement. That's been brilliant. And we'll definitely do one, Ian, on the pound US dollar. But other than that, guys, thank you so much for joining me tonight. Can I wish you, every single one of you, a fantastic evening. Until next week, every single one of you, all of you, trade safe.